All right, well, welcome everyone to tonight's webinar. Tonight we're going to talk about investing. So if you are a stock market investor, if you've ever sort of been that longer term investor or trader where you're managing your retirement portfolio, the longer term stuff, not day trading or swing trading, but let's call it investing. This is the class for you. And so we're going to take about an hour to go through my approach to investing in the stock market. I will explain the theory behind what I do, why it's effective. It's pretty simple. Anyone can do it. Here's the itinerary for our class tonight. So I'll talk a little bit about how I got started in trading and the theory behind my approach to the market, what I focus on, how long does it take to apply my strategies. You know, we were doing a poll just before we started here and talking about most people doing their research during the trading day, some in the evening, some on weekends, but it doesn't matter when you do it. It can be done in 15 minutes a day, 15 minutes a week, and I'll explain how and what approach works for what time schedule. I'll give you a little look at the Stockscores Education Center, and then at the end we're going to do some market scans, and I'll show you how I identify opportunities with the tools that I've created, which are very powerful and allow us to go through the entire stock market in minutes using some algorithms and some tools and that sort of thing. All right, so, and then at the end, we'll take questions as well. All right, so let's dive right in. The theory behind the Stockscores approach. So our aim is to find market-beating stocks. When I say market-beating stocks, I mean stocks like this. We talked about this stock last night, stock that's dramatically outperformed the market. And what I want to talk a little bit about is how I came to my approach to finding stocks like this. So I'm going to go way back to when I started investing in the market 35 years ago. For the first couple of years, I did what most people do. I did fundamental analysis. This is the things that I was being taught in university. I was a finance student at the University of Calgary, and I was learning the normal way to approach the market. The problem was it wasn't really working. And what I realized is that there was some issues with the information that I got versus the information that people in the market had. And there was a real unfairness. And we're going to talk a little bit more about that unfairness in a moment. So I decided to take a different approach. And instead of doing what I learned in business school, I decided to reverse engineer the stock market. Now, what that means is I went through all of the stocks that had done really well, all of the stocks that I wish I had bought. And I started to look for things that happened early in their upward trend. And so I can remember, you know, being a 20-something-year-old guy, printing out the charts of stocks that had done really well. And this was, you know, a long time ago, so it wasn't easy to print out charts, but I built up this binder of all these stocks that had done really well. And I printed out their charts, and I went through and started looking for patterns and things that occurred over and over again. And what I'm going to teach you tonight is what I started figuring out, you know, way back when I started. And then from there, I began to develop my different strategies, my approach to the market. What I found was that there were certain things that happened over and over again early in a stock's upward trend. And I'm going to teach you those things in this class. And what I learned 25, 30 years ago is still works pretty well today, because there's some things that haven't changed, even though technology has made how we trade and invest in the stock market very different. What hasn't changed is human fear and greed, and how the spread of information about companies is unfair. And so that's a big part of what we are going to cover. Now, as I said, we're looking for stocks that beat the market, but we also need to know when to sell them. You know, this one, the first one that I showed you here, it really hasn't given a sell signal yet. This is a stock that we hold, and it's still in a nice upward trend, but sometimes they do give sell signals. And so we had a buy signal on this stock here, and we had a sell signal on the stock there. And you can see that ultimately the stock has gone lower since then. So we not only need to know when to buy, but also when to sell. And those are some of the things that we will cover tonight. And of course, if you were in last night's class, you'll know a little bit about why I would pick the stock here and why I would choose to sell it there. And if you missed that class, make sure you check out the Stockscores YouTube channel, because it was another 1-hour class that will make a lot of what we talk about tonight make even more sense. All right, so why do stocks move in strong trends? Let's get into a little theory here and just understand why stocks make these big moves and what's the theory behind it. Because you can't really predict when a stock is going to make a big move if you don't understand why they make a big move. It really all comes down to information. Information through the filter of emotion. Now, let me explain what that means. So, companies' stock price is based on the present value of future earnings expectations. So, what the company makes in the future is really important to what the market valuation is. So if a company is making $1 million a year and then they announce a new product and it's going to double their earnings to $2 million a year, that's going to make their stock price go up when they announce that to the market. And if you have a biotech company that has $0 of profit in a year, but they're developing a drug that one day could make them billions of dollars because it cures a disease that's widespread or something, then of course that stock has value too. So a company doesn't have to make money. They just have to have the potential to make money in the future. We should always keep that in mind because there is a tendency among investors to be very focused on what companies have done in the past. Okay, what companies have done in the past is totally irrelevant to the stock price. The market looks forward, not backward. Now, good companies will do good things in the past and they'll get some credibility because of that. But the market's primary concern is not what has happened in the past, but what is going to happen in the future. And in that regard, what makes a stock move is new information about a company's ability to make money in the future. So if we had an example of a gold mining company, the company is out looking for gold. If they find a new discovery, then that is going to improve potentially their earnings in the future. If instead they're going out and looking for gold and they do drilling and that sort of thing, and they find nothing on that particular property, maybe they've invested $1 million in the exploration on that particular property, they find nothing, well, their ability to make money in the future hasn't improved, and they've just spent $1 million trying to do so. So when there's bad news like that, you'll see the stock go down. Just like when biotech companies are working on a drug, they take it to the FDA for approval. The FDA says, nope, we're not going to give you approval. We don't think this drug is effective. And in that case, you can see those stocks go from $5 down to 50 cents very quickly because they failed to improve their earnings potential. Now, just a moment ago, I said it was about information through the filter of emotion. And this is very important, something that gets missed a lot. And that is how human beings judge information is largely dependent upon their mood. So if the market is in a downward trend, the mood is negative, then companies could announce something very good for the future earnings potential, but the stock could still not go up because investors are in a bad mood. Investors were in a bad mood today because Trump had some news on tariffs around the auto industry, and it just kind of hurt the general optimism of the market today. We had a 2 or 3 day little bounce back, maybe 4-day bounce back coming into today. And then there was more talk about tariffs and just kind of some negative sentiment came out of that. And most stocks just didn't do very well today. It's not that there weren't companies doing good things. It's that the mood of the market was negative. So to understand why stocks go into strong trends, we have to recognize two things. One, new information drives the trend. So this is the fundamentals. And number two, how people judge the fundamentals is based upon their mood. So when we're looking for opportunities in the market, we're really looking for situations where new information is coming into the market. And as I talked about in the class last night, I don't wait to read about the news in news releases or on media, mainstream media, well, any kind of media for that matter, because by that time it's usually too late. What I look for is this idea that investors who know more about a company than me and most other people will act in the market when they have some new information. And what we talked about last night is looking for stocks that behave abnormally, stocks that are in sideways trading ranges and then come alive with abnormal price action and abnormal volume, because that is a clue that there is some new information coming into the market that justifies investors paying a higher price. And as more people learn about that new information, the stock can go into a strong upward trend. So in this regard, what we have to keep in mind is that the stock market is not fair. This is a very important thing to understand. The spread of information from companies, from industry sectors to the investing public, that spread of information isn't fair. Some people get better information than others, and they can act on it before most people do. Now, we could shrug our shoulders and say, oh, the market's fixed and I don't want to have anything to do with the stock market. However, the good news is when people with better information act in the market, they leave a trail for us to follow. And so when I look at stock charts, I'm not looking at them through the lens of technical indicators like MACD or stochastics. Any of you that have some experience in technical analysis will know what that's all about. I really don't use those indicators. I keep it very simple. All I want to know is there abnormal trading activity in the stock? Because when there's abnormal trading activity, it tells me that someone is trading on some significant new fundamental information that is motivating investors either to pay more because it's good news or take less because there's bad news. And if I wait until that information is widely known, until that information is made public, it's too late. Because by the time that happens, the new information will be priced into the stock. You can imagine a stock, let's say it's a biotech stock, and they're trying to look for a cure for colon cancer. And they've got a new treatment, it's a new pill you take, and it's going to fight colon cancer. Wouldn't that be wonderful? Well, if that company does that work, they do the research, they develop the drug, they go through all the FDA trials, and they announce that, hey, our new drug lowers the death rate in cancer of the colon by 37%. That's great news. That means 1 in 3 people that get colon cancer aren't going to die because of this new drug. That drug would be worth billions of dollars, right? What do you think is going to happen when they make that announcement? Stock's going to go up because it's pricing in that new information, that great news on that drug trial. Well, if you learn about that information, say 3 days later, does it have any value? The answer is no, because it's already been priced into the stock. That stock may go from $10 to $30 a share on that exciting news. By the time you learn about it, if it's already priced in, it has no value. So what we have to do is trade the market in such a way that we are ahead of the information curve. Now that either requires better information than most people get, and sometimes both, much more expertise. If you were to give me a medical report on how patients are reacting to certain drugs, I could look at it, but I wouldn't know what it means. And probably most of you here would also not know what it means. Now, if you're a doctor or you're an oncologist, you might be able to look at that with a much more educated eye and make more sense of that than I would, or than most people would. So it's not just about having the information, but sometimes you can have the expertise that allows you to predict where stocks will go. So when we look at a chart, one of the things we want to do is look for situations that stand out. And so here is a stock that I talked about last night, Emerita Resources, and it started to behave abnormally there. You can see the volume was more abnormal to the upside, price action to the upside. Until that point, for 5 or 6 months, the stock was boring and just going sideways. What does that mean? Let's think about what this chart actually means, as opposed to just seeing a bunch of green and red boxes on a page. What this means is that from here until here, the market agreed that this stock was worth somewhere between 50 cents and 70 cents. And it kind of gyrated in that range. It didn't really get above 70, but it also didn't get below 50. What that means is that based on all of the information the market had about this company's ability to make money in the future, the market said, yeah, we think it's worth around 60 cents a share. Maybe some days we're willing to pay 70, some days we'll take 50 on the downside, but we don't think it's worth more than 70 cents a share. And then some new information motivated investors to pay more than 70 cents. On this particular day, it went up to about 81, 82 cents. And it did so with double the volume that it normally traded. So I don't know anything about this company. I think they're an oil company, but I don't really know. What I know, though, is that told me that something was going on. So that was the day that I picked the stock. 2-3 months later, it's more than doubled. What caused it to double is more and more people learned about whatever motivated investors to buy it here. Now the mood was shifting to optimism. Now people were willing to pay more. And ultimately, the stock went from 80 cents to $1.90. I don't need to know anything about this company. I just need to trust that the people that know the most will act in the market and give us a trail to follow. Now, it doesn't work all of the time. There are times when investors will speculate that something good is coming. One of the best examples of that is a biotech company that is waiting for an FDA approval. It's called a PDUFA date, PDUFA. It stands for something, I don't know what it stands for, it doesn't matter. But you can actually look at websites that will tell you what the PDUFA dates are for biotech companies that are waiting for confirmation from the FDA on the efficacy of their trials, the phase 1, phase 2, phase 3 trials. Well, when a company is coming into one of those dates, when the FDA is going to either say yes or no to their drug, you'll often see the stock move up in anticipation. And then when the news comes out, it's either going to jump because the news is good, or it's going to fall because the news is bad. And usually the market will move up well in anticipation of the news because, again, some people have better information than others. There may be doctors that were part of the trials. There may be experts in the industry that kind of know what that company's been doing and can make a very educated guess on whether that drug will be good or not. Another example is, an a gold miner. So a gold mining company could be drilling for a new gold deposit on some project in Nevada, let's say. And the initial results may be good. The people close to the company know that the initial results are good. So they start to bid that stock up. They're speculating that when the official results come out, they're going to be good. And so sometimes they're wrong. And that's when a stock will have a breakout, a very good chart pattern, and then end up failing because the speculation got ahead of the actual truth or what the true information was. And so we see that sometimes. And for that reason, we always want to make sure that we have a risk management strategy because we're going to be wrong some of the time. So here's an example of that. This is a stock that I picked right here. It was in a nice sideways range, had resistance there at 220, had optimism. We talked about this in last night's class, had a breakout with abnormal volume. And look what happened. It went up for a day and then it started to fall. When it went down through this floor, the market told me that I was wrong. And so I took the loss. I took the small loss. I planned for those losses because I expect that I'm going to be wrong 30, 40% of the time. But if I'm wrong, say 30% of the time, and it costs me, for simplicity, let's say $1 a share, and if I'm right 70% of the time, and let's say on average I make $3 a share, do the math. If 7 out of 10 times I make 3, and 3 out of 10 I lose 1, because I limit the size of my losses, after 10 trades, I'm still up $18, right? 7 out of 10 times 3 is $21 of profit. 3 out of 10 times minus 1 is minus 3. So I'm making $18 every 10 trades. And again, I've simplified it to a per share price, but you get the idea. So it's really important as investors to plan to lose. A big part of what I teach in my courses is risk management and knowing where to take a loss, because you can't just pick an arbitrary number. You have to look to the chart and say, where's the floor? Okay, there's the floor. We talked about inflection points last night. And there's the breakdown through the floor from a falling top. So that told me that when that happened, the speculation that caused the breakout here was wrong. And we have to do that. And if you do that, if you don't take the big losses, then your winners will pay for your losers. However, what most people do, if they're normal human beings, is most people hang on to their losers, hoping that they're going to turn around. And a stock that's maybe losing $1 a share might trend a little lower. Now it's losing $2 a share. And then it might trend a little lower. Now it's moving to a $3 a share loss. If that trader had just taken the early loss when the market told them that they were wrong, they would have capped that loss at $1. But what most people do is they let those losses get worse and worse and worse. And now they need 3 or 4 winners to pay for the one loser. It's much better if you could have 1 winner pay for 2 losers, or maybe even 3 losers. And that's our goal. And that's a big part of what I teach is in the risk management. All right, so the next concept we're going to talk about is when we are right, we need to let the trade work. Because again, the winners have to pay for the losers. We're going to have some losers, it's inevitable. So if we look at this one, this stock, again, I picked it right here, and it just has been trending higher ever since. Upward trends don't go straight up. A typical upward trend goes up and it goes sideways, goes up and it goes sideways, little pullbacks, goes up, goes sideways. And the trend line that we look to be broken is drawn across the pullback lows. So you can see that here. Here's a pullback low, here's a pullback low, and I can draw a trend line across those pullbacks to define the trend line. As long as that trend isn't broken, as long as it's in place, then I'm going to stick with that trade. It would be very tempting, to say, okay, I bought this stock at 450 and it started to show a little weakness at 550. I'm going to get out and take my profit. You may have heard that saying, you never go broke making a profit. There's a lot of people who try to encourage investors just to take the profits quickly and not trade for the maximum gain. And I agree with that a little bit. Like, you don't want to try to get every penny out of a trade, but if the trade is working, let it work. As long as the trend is up, be patient. There's a saying, the profit is in the patience. And so again, if you're a normal human being, it's very tempting to take those early profits when there's a bit of weakness. Maybe even here, there's a little bit of a breakdown there. It never broke the upward trend, but it could easily have spooked people. Right here, this little down day could easily have spooked someone, but it didn't break the trend line. I draw the trend line here from the starting point and across the first low, and I extrapolate that line forward and notice it pulled back to the line, never broke, and then continued higher. Whereas some situations, some stocks actually break the trend line. I showed you a chart of SOUN earlier in the presentation, and that one went up very quickly, broke the trend line, get out, and it ended up being a good decision to do so. So what do I focus on? Number one, I focus on abnormal trading activity. And I've built some tools that I'm going to show you in a moment that will help me find stocks trading abnormally. In fact, we'll go in search of some, and I'll show you how it's quite an effective method. Once I have abnormal trading activity, I then inspect the chart pattern. Because as I said in last night's class, all stocks, well, not all, almost all stocks that make market-beating trends start their trends with abnormal activity. However, not all abnormal activity leads to market-beating trends. And so we have to qualify the abnormal activity by looking at chart patterns. And a big part of what I teach in my courses is how to read chart patterns. It's not hard, it takes practice. Like anything else, if you can practice it for a while, you'll get good at it. We're going to do a little bit of that tonight and tomorrow and again on Saturday. Risk management, so important. We have to limit the size of our losses. We have to size our positions properly so that every stock has the same amount of risk. Let me say that again. We can make every stock have the same amount of risk, whether it's NVIDIA or some biotech stock trading at 50 cents. We can make them all have the same amount of risk simply by adjusting how much of the stock we buy. If a stock is very volatile, then we buy less of it. If a stock is less volatile, like NVIDIA or Microsoft, NVIDIA is actually quite volatile, but say Microsoft, which doesn't move a lot percentage-wise, well, then we buy, in dollar terms, more of it to have the same amount of risk. Now, if you have less capital, then you should be trading lower priced, more volatile stocks because your position sizes can be smaller. Number 4, be a good loser. The best loser wins in the stock market. The trader who is able to take the small losses and not let them grow into big losses is going to be a much more effective investor. Finally, we need to have patience with our winners. When we have a good stock, when the trend is up, stick with the winner as long as the trend is up. Now, we'll go through some examples when we do a market scan, and I'll show you a little bit about understanding the trend and where to draw the trend line. So stick around. We're going to do that in just a moment. And then the last thing, we shouldn't be trying to get in at the low or out at the high. Again, human beings are emotional. We have this thing called a fear of missing out. So sometimes when a stock is going down, we feel like it's a bargain. We want to buy it, and it's like trying to catch a falling knife. So we never want to try to buy stocks at their lows. We want to buy them a little bit off of their lows when the momentum turns. By the same token, when a stock is going up, we're not trying to sell at a high. We're not trying to predict where the high will be. We shouldn't be selling at price targets, but instead, when the trend is broken, when there is an actual sell signal, that's when we're going to get out. And that means that we're not going to capture the first 10 or 20% of the move and the last 10 or 20% of the move. We're trying to capture the middle, the 80% in the middle there. And by doing that, by having that mindset of not being greedy and not worrying about what we might be missing out on, we can be a much more effective trader. One of the things we have to remember is that the stock market gives us new opportunities almost daily. And so we can be in and out of a trade and make a good profit on it. It doesn't matter if it goes up a little more after we exit, because we can take that capital and put it into something new that has better potential. In order to do that, we need to have good strategies and good tools so we can find these things in a timely way. So here is an example of NVIDIA, and let's sort of look at this chart and capture what we've talked about. So this is a weekly chart, so very long term. This would be for a longer term investor. So there was some buy signals earlier on this chart, but let's use this one right here. This is the sideways trading. It had a ceiling price at $50 a share. What that meant is coming into 2024, January, investors didn't believe that the stock was worth more than $50 a share. Based on all of the information that the market had, that's what it felt was the upper value. It was building optimism because it had rising bottoms. And then right here, it broke through that $50 a share mark because some investors had some new information that justified paying a higher price. And look what happened. It went into a nice upward trend. Now, an investor with a relatively sort of short-term time horizon, a more active position trader, might have sold right there when the upward trend was broken. Remember, this is a weekly chart. A longer-term trader would say, I'm going to draw a trend line on the weekly time frame using the pullbacks as the thing that defines the trend line. So we go up, we pull back, we bounce, that's an inflection point. We go up, we pull back, we bounce, that's an inflection point. And all I'm doing here is connecting the dots to draw a trend line. Well, when was that trend line broken? It was broken right here, late in January 2025. Now then it rallied up for a couple weeks, and then now it's been going lower since that time. If you sold there, you're no worse off. You captured that trade from $50 to $120, $130. And in the last 2 months, it's not really any higher. Now I think it's at 112 right now, 113.80 is where it closed today. All right, so we'd only want to know when to buy, but we also have to have a methodology for when to sell. And this is a little hint on how we do that. So how long does it take? Well, if you are a position trader on the daily time frame, then you're going to do your research each day. Most days, you don't have to do it every day, but 15 minutes a day. We're going to use 4 different strategies primarily: the Stockscores simple, the action breaks, the bottom fishing, and the abnormal breaks. These are things that I teach, and I'm going to show where you learn that in just a moment, but that's doing it for 15 minutes a day. Now, at the top of the lesson here today, I talked about when do you do your research. Some of you said you do the research on the weekends. All right, then you're going to focus on these strategies where we're looking at weekly charts and maybe only doing 10 or 15 trades a year. So much less active. These people might be doing 30 or 40 trades a year. These people are looking at weekly charts. These people are looking at daily charts. Typical hold period here is a couple of months, 2 to 3 months. And here it might be a year or more, 1+ year. And I'll show how we do this in just a moment. So how do I find opportunities? I use something called the Stockscores Market Scan. This is a tool that I created that allows me to scan the entire North American stock market in just a few minutes. Now, when you first start out, it takes a little more time. But as you gain experience, you can do it a lot quicker. And we're going to do this together in just a moment. It uses filters that are unique to my approach. So if you were to go to any other sort of filtering tool, you probably aren't going to see the things that are in the market scan because they're my own algorithms that I've been developing over the last 35 years. Most importantly, these tools and these strategies will save you time and allow you to focus on making money. Now, before we do a market scan, I'm just going to talk about how you learn what these strategies are. We do that on the Stockscores Education Center. This is an online resource where I have created lessons for the theory on how to read charts, how to manage risk, how to know when to sell, trend lines, all these different concepts. We've talked a little bit about them tonight and in the previous class last night. So that's the theory. We call that the foundation. And then once you understand those concepts, then you can dive into the actual strategies for investing, which is what we're talking about tonight, or active trading, which is what we're going to talk about tomorrow. So if you have more of an interest in day and swing trading, make sure you're registered for tomorrow's webinar because we'll go into that then. So let's jump in and just take a quick look at that Education Center. So I go to Trader Training, Education Center. This is a member-only area. Non-members can look at these lessons, but these are pretty basic ones. So here's the foundation lessons. And so if I wanted to learn about scaling or how I reverse engineer the stock market, the basics of options, risk management, you can see them all here. Now for each lesson, there is a written component, so I can read about it, or I can watch a video. So here is a video that's, I don't know how long this is, 30 minutes. So this particular video is 30 minutes. It's on how to read chart patterns, essentially. And then there is a little assignment. So here's some questions so that you can make sure that you understand how this all works. And then there's also a little quiz. Where is the quiz? This thing right here. Oh, look, I got 100%. So here you answer some multiple choice questions and make sure you understand that particular concept. Okay, so that's the Education Center. Now, the foundation has those 4 components. And then if we go down to the investor section, you see here that there are lessons on the strategy. So let's say you are an investor who does your research on the weekends. You want to be fairly long-term, not be very active. Then you might focus on the Stockscores simple weekly strategy. And again, there's a lesson, written lesson, and there is a video that explains that particular strategy. There's strategies for different time frames, different approaches. You know, if you want to be a shorter term trader, then you're probably going to focus more on the action candle break strategy, which is one that we might do a little bit of tonight. And then if you're into day trading and swing trading, then there's a whole section of strategies for that as well. But tonight we're going to focus on investing. So what does the investor course cover? Well, it gives you access to those lessons in the Education Center, the foundation theory lessons and the investor strategies. Now, these strategies are the result of my 35 years of trading the stock market. My picks last year returned about, I think, 41%. And so you're going to learn those strategies that I use to pick stocks using kind of what we've talked about tonight. Well, not kind of, totally what we've talked about tonight, but with a little more sophistication. It gives you access to the investor strategies in the Market Scan tool. I'll show you that in just a moment. A big part, and I think really the most important part, is you get email support from me. Because when you start out learning this, it's new, it's maybe a little bit overwhelming at first. It takes a little bit of time to go through the material and learn it. And if you have questions, I'm there to help you. As I've talked about in the past classes we've had, I don't teach a lot of people every year. It's not my primary business, is not to, run a website. It's meant to, allow me to develop these tools that I use in my own trading. They're very expensive to not only build, but also to keep up and running. For data, I pay $5,000 or $6,000 a month just for data. And I spread that cost out by having a relatively small number of students each year, less than 100 each year. You also get 6 months access to the Market Scan tool with the course, and that is renewable at $300 a year. So, that $300 a year is going toward paying that $6,000 a month that I have to pay to keep the data up for the Stockscores website. Now, the Active Trader course is what we'll talk about tomorrow, but very quickly, you get access to everything I just talked about, but also the Active Trader strategies, and you're also eligible for a live daily webinar that I do in real-time market conditions called Active Live. We'll talk about that again tomorrow, so I'm just going to skip past this because it's not so much about tonight. Now, in addition to the online training, twice a year, I do some live training where I will walk you through the theory, and then we will practice doing market scans together. So Monday, April 7th and Tuesday, April 8th, we're going to do the theory classes, hour and a half each night from 6 till 7:30 Pacific time. And then the Wednesday, Thursday, Friday that night from 6 till 7, I'm going to do market scans with you so that we can practice picking stocks. My goal is not to give you a fish, but to teach you how to fish. And so we're going to do it by practicing. I'm going to tell you what to do, and then I'm going to show you how to do it. And then a month from now, if you're not sure about what you're doing and you have a question, I'm there to help you. And I answer all those questions personally, typically within a day. Now, for those who take the path of the Active Trader course, then you also have access to Active Live included with the course for a month. But again, we'll talk about that more tomorrow and on Saturday. All classes that I teach are recorded, so you'll be able to watch them 100 times if you want. If you can't make Tuesday, April 8th, because you have pickleball night that night, no problem. You can come home and watch the video after you've played your pickleball. All right, so what's the special offer? So every year I do some special offers, and the main thing is you're going to get this live training for free. Anyone that registers for the courses, either of them, before Friday, April 4th at 11 p.m., will get these classes for free. Now we're going to talk about the mentorship more on Saturday, but very quickly, if you want me to hold your hand through the learning process, I do a 6-week, 2 classes per week mentorship program. So if you think you would benefit from having me really hold your hand through the learning process, then the mentorship is something to consider. We'll talk more about that in Saturday's session. Here's the pricing. This is all in Canadian dollars, and people in Canada have to pay the GST sales tax. But if you're outside of Canada, there's no taxes. The investor course, $2,995 Canadian. The Active Trader course, which includes the investor course. You get everything, $39.95. And if you do the mentorship, it includes the active trader and the investor, but also the 6-week, 2 1-hour classes a week. That's $59.95. If you prefer getting a better deal, okay, great. Here is $500 off using these codes. And I'm going to give you a way to get on my mailing list where I'll send these codes to you. We'll do that in just a moment. If you would like to register for the class or learn more, go to stockscores.com/learn. The deadline for getting the free live training and the $500 discount is April 4th. That's next Friday. Now, the next thing I'm going to do before we get into a market scan and before we get into questions is just put up this poll, because as I said last night, I'm not really into pushy sales. So if you would like an email with a little more information on the different course options, just answer this in the affirmative. And if you'd rather not have me send you an email, then just say no, and I won't bug you at all. And again, it's just all about not trying to be too intrusive. So just let me know, are you more interested in the investor course, the mentorship, the active trader course? It allows me to sort of understand what to do. And then as soon as we're done with this poll, we're going to do some market scans. I'm going to do 2 market scans, one to show you the sort of proof of what I've talked about tonight, and then 2 to see if we can find something. Now the market was down pretty significantly today, so I don't know that we're going to see a lot, but we will take a look nonetheless. Okay, I'll leave this up for another 10 seconds, so try to get your answer in here in the next 10 seconds, and then I will close the poll. And then before we do questions, I'm going to run some market scans. All right, so let's close this poll down. Thank you for answering. And if you answered yes to any of those, then you'll get some emails from me on Sunday, most likely. Yeah, Sunday afternoon. All right, so let's go to the market scan tool on the Stockscores website now. And what I want to do first is let's first do what I did back in the old days, where I reverse engineered the stock market. So again, 25 years ago, 30 years ago, my approach was to say, show me all the stocks that have done really well, and let's see what they were doing early in their trend. So what I'm going to do is look for stocks that are up at least 100% in the last 60 days. So that's pretty big gains for the last 3 months. And I'm going to say that they have to trade at least 5,000 times a day, so we have stocks that are fairly actively traded. So I run that market scan, and there's 13 stocks that in the last 60 days have gone up at least 100%. Now, there's some stocks that may have gone up 100% and then fallen again, and they're not going to show up on this list. But this is a good place for us to start. So what I'm going to do now is look at the charts of these stocks, and we're going to try to figure out if these stocks had some abnormal activity before they made a big jump. Now in this case, FUBO had some abnormal activity there, but it really didn't do much for 3 months before a really big price gap there. So, I mean, I day traded this stock in these days, but as a position trade, it didn't really have a lasting trend. So let's move on to the next one. Okay, so here we can see a stock that has had a pretty good trend over the last 3 months. It's gone from, $1.50 here to hitting $5.50 just a couple of months later. So you buy 1,000 shares at $2 and you sell it at $5. That's a nice $3,000 profit. But what I want you to focus on is what we've talked about. Remember I said that most strong upward trends start their upward trends with abnormal activity, abnormal price movement and abnormal volume. And ideally that comes from low volatility. So there's abnormal price, there's abnormal volume, and here's low volatility. So this one checks out. It did that. Let's try another one. Here's a stock that started behaving abnormally just 4 days ago. We've actually been day trading this in my active live service. If I was to look on the intraday chart, so I'm going to go on the 15-day chart, and we'll make this maybe even 10 days just to see a little better. You see here, that was on March 21st. It had this very abnormal volume, abnormal price action from low volatility. That was at $1.30. Today it's at $4. I've traded this stock. I can't tell you what they do. I don't know. I don't care. I'm just trading market action. Here's another one. This, again, a stock that we've traded the last couple of days. See how the volume has been much higher over the last 5 days? Again, if we were to zoom in on this and look at the last 15 days, you can see that it was boring, and then it came alive with abnormal activity, abnormal price, and abnormal volume. That was in the $1.40 neighborhood. Now it's at $4.20. Now you might be wondering, why is the stock score so bad? It's because this stock has gone up so fast. And one of the things I built into the stock score is if it goes up really quick, it actually loses points because I don't want to be a buyer of the stock up there. I want to be a buyer down here, but not when it's gone up 300% in 3 days. Let's keep looking. Okay, here's another one. So we talked last night about optimism and pessimism. And again, if you didn't take in that class, go to the Stockscores YouTube channel because you're going to learn a lot that will be important to understanding how to do this. But anyway, here we had pessimism, falling tops. So pessimism, never consider. Then it switches to optimism. We had rising bottoms. And then it starts to break with abnormal activity. You can see the volume coming in and the abnormal action. And then it really starts to go. The public is buying up here. Do not be part of the public. You want to be part of the group that follows the smart money and be a buyer when it just gets started. Let's look for another one. Okay, here's pessimism. We told do not consider pessimism. But then it switched to optimism because we had rising bottoms. And then it made an abnormal price move from low volatility. The volume was picking up compared to what it had been. That was at just under $3. Now it's 4.5. Next one. Now everyone take the time and look at this chart and try to see where it started to trade abnormally, where it broke from low volatility. I'll give you 5 seconds and then I'll show you. So here you have low volatility, abnormal price movement, abnormal volume, $1.50 a share, now it's $6. Go through a couple more here, but I think you're getting the idea. I'm trying to prove to you that most market-beating trends start with abnormal volume and abnormal price action from low volatility. There's another example. Let's take a look at this one. Boring, abnormal, big gain. It's come back the last few days, but you could be in and out of it by then. Boring, abnormal, big gains. Here, this stock is probably a buyout because anytime you see a stock make a big price gap like this and then go sideways with hardly any volatility, that's usually a buyout. So if you went and looked up the news on CMRX, I'm pretty sure you would see that this stock is being bought. The market was speculating on that here. Here's where the news came out. Do you want to be part of the group trading the news, or do you want to be following the smart money? Let's look at one more. Boring sideways trading, abnormal price action, abnormal volume, away it goes. All right, so how do we find these? It's all well and good with hindsight, but let's try and find them. Well, we can build a market scan that looks for this. Let's look for stocks that had an abnormal day up with abnormal volume and at least 5,000 trades. We can run the scan. I do this every day. Some days I find some days there's nothing good. We then need to go through these charts to see if they have the right kind of chart pattern. What I do not want is stocks moving up into pessimism. You can see the abnormal volume. You can't even see the abnormal price action, and this is nothing but pessimism. So this is a no-go. Now, if I wanted to, if I didn't want to see stocks in downward trends, I could have added to my market scan that the stock has to have a sentiment stock score of at least 50. I didn't do that because I should have actually. A lot of pessimism there. See the stock scores, 33. A lot of pessimism. And by the way, I'm still interested in day trading a stock like this. In fact, we day traded this stock today, but I do not want to be a position trader because it's got too much pessimism. But a day trader doesn't look at the daily chart. The day trader looks at this chart. And on this chart, we had a break of a pullback right there, which was a great entry point. That's a strategy I teach for day trading called, guess it, a pullback play. But the thing is, you have to apply a pullback play to the right kind of chart. It has to be a stock that's abnormal, liquid, And we use tools like this to find them. Okay, that's underneath resistance. That's got lots of pessimism. This is moving up into pessimism. I did the scan earlier. I don't think that there's anything today because we had a pretty negative day with the tariff stuff today. There's still stocks to trade, but they were more short-term trades. I'm trying to find some good longer-term things. We'll do this scan again. We'll try it again on Saturday. So make sure you're at Saturday's presentation. We'll try to do a scan then as well. So here's one that's a little better. It's making a move from low volatility. The problem is it's going to have a ceiling price right there, and the upside isn't good enough for the risk. So I wouldn't do anything on that one. That's not good. That was the last one. All right, so that's the process. Is I start by scanning with the market scanner, goes through every stock in North America, looking for stocks that are behaving abnormally. And then I look at the charts, apply the lessons that I teach in the course material in the education center to know when to buy, when to sell, know whether some things are good. Most stocks that we look at aren't good. If I look at 20 stocks, I might only like one. And a big part of what we'll do in that week of lessons starting April 7th is we're going to practice that because I have to teach you how to be fussy. Most people aren't fussy enough. I'm going to teach you how to be fussy if you're in that course. All right, so let's just put this up, and I'm just going to try and read some questions here. So one question, so do you run this scan 1 hour before the end of trading day or at the beginning of the day? I prefer to do it about an hour before, maybe even half an hour before, but you can do it anytime, not in the first hour, but maybe after the first hour. Someone just letting me know they did find the news and Jazz Pharmaceuticals is acquiring that Chimerix. Now, someone asking about if you took the course last year, can you watch the April courses for free? Everyone gets a free run of the of that foundation week. We call it Foundation Express. So it depends if you've had it already. If you haven't had it, you can repeat it for $195. If you email me, I can look into it for you and let you know. How do you deal with a stock that goes up with abnormal volume when the news comes out, people sell off and it turns down rather quickly? Well, we always have a selling method. So if a stock is moving up nicely, we're always moving up our sell point. And if the stock rolls over and goes down through the sell point, then we just get out. So that's the typical approach. Someone asking LUCD, where to next? We can look at a couple stocks here. Let me just, whoops. Just got to get into the Stockscores website. LUCD, where to next? Well, I can give you my analysis. Nothing is for sure, but yeah, this looks pretty good. So first of all, who's in control? Buyers, because there's rising bottoms. It has some resistance here. I expect it's going to stall here a bit, but it looks like it has pretty good potential to break through. If it starts to move through $1.60, that would be good. And the $1.60 is this resistance level. So this pattern is something called a cup and handle pattern. So you can see it looks like a cup with a handle over here. When you get a breakout through the handle, they usually go up. So I like this stock. I've been watching this one for a little while. Someone asking if I can analyze Dell, D-E-L-L. Not great. You can see the sellers are in control, so it's pessimism. Let's look at a little longer term time frame here, just to get that big picture view. Yeah. So the trend went parabolic. Parabolic trend was broken in here. That was the sell point. Then it built a falling top and then broke down from a falling top there. So that was sell point number 2. It does have support here, so it may bounce off of this, but until this trend line is broken, this downward trend line, I would stay out of this stock. All right, I think I've covered everything that I wanted to. We did the poll. Inactive trading plan, do we do live trading with you? Yep, we do that every day. We have like a live webinar that runs every day, and I call out some stocks and show some things. But again, I'm not really looking to tell you buy here, sell here. I want to teach you how to do it. I want you to be able to be independent. So I give you examples. I'll say, I think, PSTV is a buy here and here's why. But ultimately, I'm trying to teach you how to do it so that you can do it on your own. If the market is going down, bear market, can the scan handle shorting? It can, but in this market or in this time, I prefer to buy inverse ETFs. They're just an easier way to take advantage of the market moving lower. Okay, I think I've got all the questions. I'm going to wrap it up. And if I missed any of your questions, please email me. There's just a whole bunch rolling in, and it's a little bit hard to track because my screen keeps scrolling through them. So, but anyway, I hope you found this useful. Now, just a reminder, tomorrow's session is on day and swing trading. So you can register for that if you haven't already right here. Winning strategies, day and swing trading for part or full-time income. That's tomorrow's topic. And then this is Saturday's topic where I'll show you more about my tools. The Education Center will take a little deeper dive into that. And then those who want, like if you want to, let's say you're a student, you took the course 4 years ago, and you want to redo that week of classes, you can register for that here as well. All right, I will wrap it up there. Hopefully you got something out of tonight. Hopefully we'll see you tomorrow, and trade well. Have a great night.